Hey, and welcome back to another episode of the Friday Five. I am back in the studio after a number of weeks, either at the Wheels of Time, shooting on location, on vacation, just out of the office for a whole bunch of Fridays in a row. I'm happy to be back here in the studio where I have all of my editing and recording toys at my fingertips. All right, we're going to jump in and start where we always start with number one, mortgage rates, national averages from Mortgage News Daily. VA 30-year fixed 6.08%, FHA 30-year fixed 6.06%, conventional 30-year fixed 6.5%, conventional 15-year fixed 5.86%, and then conventional 7-year ARM 5.9%. So we have seen some nice improvement in mortgage rates over the last, really month or so. We are at the best levels that we've seen this year so far, and there's definitely some momentum based on economic news, Fed policy statements, expectations for Fed rate cut in September that are leading towards better mortgage rates. So we shall see if the momentum will continue, if we'll kind of flatline here in like that mid-6 range for the conventional and right around 6% for the government products, FHA, VA. But it certainly is a nice improvement over what we had seen earlier in the year. Number two, let's discuss something that's been in the media recently, mortgage fraud. So there's a bunch of different types of mortgage fraud that can occur. You have occupancy, income, identity theft, appraisal fraud, straw buyers. But I really want to focus on occupancy fraud because it's come up a couple times recently in the news, and you can Google it if you want. I'm not going to get into specific stories. But essentially, here's what you need to know. When you apply for a mortgage, the guidelines differ based on the occupancy for the property. If it's going to be a primary residence, then the down payment requirements are less than what's required if you're buying an investment or second home purchase. And the interest rate is typically lower on a primary residence purchase versus an investment or a second home. So there are certainly buyers who will try to say that a property is going to be a primary residence when it's really going to be an investment or a second home. So you might ask, is this really a big deal? And here's why I'd say yes. Yes, it is a big deal. Here are the potential outcomes of mortgage fraud committed by a borrower. First, loan denial, obviously, if it gets caught during the loan process. Loan acceleration, which means that you had 30 years to pay it off, but we found out that you committed occupancy fraud and now the loan is due and payable today. Foreclosure, credit damage, civil liability through a lawsuit filed by the lender or the investor. And then last, but certainly not least, criminal charges, which could carry up to fines of $1 million, prison time up to 30 years, and also restitution requirements. So in my opinion, it's just not worth it. Apply the right way, do the right thing. And if you're working with a lender who is suggesting that you lie about the occupancy or anything else on the mortgage application, you should run the other way, and then you should call someone, a regulator, and report them, because we don't need bad actors in the mortgage business. Number three, what is the Homestead Act discount or the Homestead exemption, and why should you care? So the Homestead Act discount or exemption is a property tax benefit that many states and local governments offer to homeowners who live in their home as a primary residence. Essentially, if the property is your primary residence, you get a reduction on your property taxes provided you have applied for it and are approved. So how do you apply? Well, in most areas, you fill out a form and return it to your local tax collector, usually with the county. It's pretty simple. So how do you check to see if you're actually receiving it or if you applied and if you've been enrolled? Well, you can call the local county to see if you're already enrolled, or you can just go to your local assessment section on your local county's website and check the tax records. So I'm going to show what it looks like here for Lehigh County. This first property, which happens to be my house, is approved and enrolled. And then if you look at this second property, my buddy Steve, and clearly need to call him, he is not enrolled. It doesn't look like he ever filled out the application and submitted it. So he's probably losing out on at least a couple $100 in tax benefits. So if you're curious about the homestead exemption or if you're enrolled, please feel free to reach out to me. I can help you figure out if you're enrolled or if you aren't. And if you aren't, we'll help you get that application submitted so you can get enrolled and apply that discount to your property taxes. Number 4, in a previous video, I covered what an appraisal waiver is. Essentially, an option where a borrower is able to avoid doing an appraisal altogether on their home purchase. But this time I want to talk a little bit about the mechanics of an appraisal waiver or how a loan is eligible for an appraisal waiver. Earlier in the week, I had a client go under contract, buying a property, putting approximately 25% down, and his agent asked if he got an appraisal waiver, if we're able to avoid doing an appraisal. And through that conversation, I could tell she wasn't really sure how it was determined whether an appraisal waiver was possible or if the loan was eligible for that. So here's how it works. When a lender has a loan application, we run that loan through an automated underwriting system created by Fannie Mae or Freddie Mac if it's a conventional loan. Freddie Mac's system is called LP, Loan Prospector. Fannie Mae's system is called DU, Desktop Underwriter. Essentially, when we run the loan through that system, it analyzes credit, income, assets, and then once you put the property address in for the property that they're purchasing, it's also running some type of AVM or automated valuation module behind the scenes to try to determine some type of value for that property. The lender doesn't see it on the front side, it's kind of in the back side. And essentially when we run the loan through, it either tells us it is eligible for an appraisal waiver or it is not and a full appraisal is required. There doesn't seem to be a lot of rhyme or reason for it sometimes. I have a client right now who's purchasing a house and putting over 50% down, and it didn't score eligible for an appraisal waiver. Yet last week I closed a loan where a customer was putting 10% down, and it did score for an appraisal waiver. So I think it has more to do with the property address and is that purchase price supported by the AVM that's running behind the scenes. But ultimately, the lender doesn't choose it. The system chooses whether the loan is eligible or the property is eligible for the appraisal waiver. Number 5, quote of the week. This comes from Albert Einstein. In the middle of every difficulty lies opportunity. I love this quote. Life's always going to throw you some challenges and curveballs, but hidden inside every one of those challenges is a chance to grow, learn, rise stronger, become better. There's always opportunity to grow. So take advantage of those challenges and don't look at them as a negative, but find ways to turn them into a positive. Thanks for watching. I hope you have a great Labor Day weekend. If I can help you in any way, please reach out.